What unfolded overnight while most retail investors slept? In the pre-dawn hours, 633 institutional traders executed one of the boldest coordinated short-selling operations against silver in recent times. They struck when liquidity was at its lowest, ensuring retail participants were offline and unable to counter, and targeted precise technical levels to set off widespread stop-loss triggering. The paper price was driven down to the lower end of its recent trading band right before the release of PCE inflation figures, which exposed the Federal Reserve's difficult position. This wasn't mere coincidence or organic trading. It was deliberate, synchronized price suppression carried out by the very institutions also pulling physical silver from COMEX vaults at a rate of about 785,000 ounces daily. The proof lies in the trading data, and I'll walk through precisely what occurred. Quick note from John A.G. Alert. I will never charge for signals, courses, mentorship, premium access, partnerships, or invite you into paid groups. Anyone claiming to represent this channel and asking for money is running a scam. Report them right away. My goal is simply to highlight institutional tactics, so everyday investors grasp the real dynamics at play. This is educational material on financial market warfare, not investment advice. Always cross-check claims with original sources and decide based on your own situation. The overnight assault in detail. The move kicked off around 3:47 a.m. Eastern Time in the thinnest liquidity portion of the 24-hour cycle. Asian trading winding down, Europe not yet active, and U.S. retail asleep with only minimal institutional staffing. Thin order books amplify the effect of large sales. Over a tight 23-minute span from 3:47 to 4:10 a.m., more than 12,400 contracts, equivalent to roughly 62 million ounces of paper silver, were dumped. That volume surpassed the total from the prior 4-hour session. The focused, high-volume selling and ultra-low liquidity was engineered for one goal: aggressive price depression using as little capital as possible. Silver fell from $79.12 to $77.84 in under 25 minutes, a 1.6% slide. Critically, it pierced the $78 psychological barrier, activating clusters of stop-loss orders below that mark. Those triggered stops fueled further automated selling, turning the decline into a feedback loop. COT data and exchange clearing records point to the players. 633 separate commercial trading accounts, bank and institutional, increased short positions during that overnight period. The net commercial short position rose by roughly 8,400 contracts in one session. These 633 accounts form a tightly linked group that acts in concert to control precious metals pricing, not as rivals, but as a single entity pursuing shared aims. Why this timing stands out. The assault happened less than 12 hours ahead of PCE inflation data showing 2.9%, above the 2.8% consensus forecast. Anyone with solid economic models or advanced insight would recognize hotter inflation as typically supportive for precious metals. By hammering the price overnight, they established a depressed starting point, capping any subsequent rally tied to the data. This flips the classic sell the rumor, buy the news tactic. Suppress ahead of favorable news, so even a positive reaction yields only a muted move. Retail sees a small uptick on PCE and thinks the market behaves normally, unaware the prior night's action had already limited the upside. How the system enables this COMEX commercial participants, largely bullion banks, enjoy advantages unavailable to retail. Exemptions from position limits, direct exchange credit for near unlimited leverage, and private channels for alignment. When 633 accounts pile into shorts simultaneously in a 23-minute low liquidity window, it's not independent analysis converging, it's coordinated execution to push price deliberately. The synchronization is itself proof of coordination. Recall JP Morgan's $920 million 2020 settlement for precious metals manipulation over nearly a decade, involving spoofing fake orders meant to cancel. Penalties were treated as business expenses, with little personal fallout, so similar tactics persist. Today's 633 traders follow the same script, but physical supply tightness now imposes limits absent in earlier periods. The glaring contradiction? While those 633 accounts built paper shorts overnight, COMEX registered silver inventories fell another 847,000 ounces per the latest vault report. Paper shorts expand as physical metal exits vaults. Entities short paper claims, while removing the underlying physical asset, create the ideal manipulation setup. Short paper to keep prices down. Buy cheap physical at suppressed levels, deplete deliverable stock needed for shorts, eventually cash settle shorts at manipulated paper prices, while retaining far more valuable physical. JP Morgan reportedly amassed 750 million ounces physically over the past decade using this approach, holding the biggest paper short while building the largest physical stake. The short kept accumulation costs low, flipping to long, later captured gains on both sides. The current 633 account buildup may mark the endgame, one final suppression before March delivery forces physical limits to dominate. Accumulate last physical at low prices, then permit the rise, profiting from paper reversal and holdings. PCE timing adds manipulation evidence PCE releases at 8:30 a.m. ET. Advanced traders model incoming data monthly and anticipate hot prints. Knowing bullish implications, they preemptively suppress overnight to hit retail stop losses below technicals, open lower cover levels for partial short profits, dampen any PCE-driven rally. Sow doubt and fear among retail holders waking to lower prices despite strong fundamentals. The psychological blow is intentional. Retail sees unexplained drops and muted responses to bullish news, questions their position, and sells physical to knowledgeable buyers. This engineered weakness transfers metal from retail weak hands to institutional strong hands at artificial lows. The 633 aren't chasing long-term lower prices. They aim to scoop physical from panicked retail during temporary weakness. Linking to the larger supply-strained COMEX registered, silver now stands at 98.1 million ounces after Thursday's withdrawal. March 1st, notice day is 7 days away, with open interest covering 429 million ounces of paper claims, a coverage ratio nearing 4.4.1 and heading toward 5.1. Paper shorts grow while physical departs vaults, an unsustainable mismatch. Resolution requires either buying to cover, lifting prices, impossible delivery due to low registered stock, or emergency exchange actions, exposing paper physical disconnect. Shanghai silver trades around 130 Oz versus Western paper at $78, a $52 premium reflecting real physical demand and delivery insistence. Shanghai recently penalized 6 coordinated clusters, buy shark traders, for similar low liquidity short attacks during Lunar New Year. Western regulators, CFTC, note concentrated shorts exceeding limits but impose no serious action. What the overnight move signals, adding shorts and engineered low liquidity crashes typically sets up for lower price covering or indefinite rolling. March delivery, however, sets a hard limit. The new 8,400 shorts, 42 million ounces, lack backing in registered inventory, naked paper positions, relying on cash settlement or no delivery calls. If even a fraction of March longs stand for delivery, these shorts face massive losses, forced buybacks at higher prices, or unfulfillable obligations, potentially triggering public emergency measures. The 633 bet longs won't demand delivery the paper system endures, and 7 more days of suppression carry through without breakdown. Vault outflows, Shanghai premium, and 8% lease rates suggest growing physical insistence. This attack may be the last major suppression before physical reality prevails or the system staggers on. Key takeaway. Regardless of outcome, exchange records document 633 institutional accounts acting in unison during deliberately thin conditions. Timing preceded bullish PCE data, implying positioning on expected news. Paper diverged from ongoing physical withdrawals. Institutions building paper shorts hold huge physical stakes profiting from eventual shortage-driven rise. Retail selling into weakness handed metal to orchestrators at suppressed prices, a designed wealth shift. The pattern has run for decades. JP Morgan's $920 million fine changed little. Coordination that would draw prosecution for retail goes unchecked for institutions with exchange privileges, leverage, and de facto immunity. The game persists until physical limits end it. We may be 7 days away. March 1st, first notice day test paper versus reality, 98 registered ounces versus 422 in UNEP's claims, 633 new shorts amid vault drainage, PCE at 2.9% trapping the Fed, Shanghai at $130, proving $78 paper undervalues metal. The overnight operation was coordinated, traceable in records, and participants identifiable. Manipulation holds until physical constraints shatter it. Check overnight volume and exchange data, Friday's QOT report, and daily COMEX vault updates. Evidence sits in public primary sources. This is education and financial warfare. You're up against 633 synchronized institutions with special advantages. Know the opponent, position thoughtfully. The fight goes on, 7 days until paper meets physical reality.